Tom Boley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Tuesday, June 18th, 2024 edition of Trading Places Live. You're here at earningsbeats.com. I'm Tom Boley, Chief Market Strategist at Earnings Beats, and I'll be your host here for the next 30 minutes or so as we take a look at the action from yesterday and also what we might expect today.
Hey, Tom, could you move your mic a little bit closer?
Oh, good point. I thought I was all set up. You are right.
Hey, no worries.
Yep. Thanks for catching it so early there. Appreciate it. Anyway, do welcome everyone to the show. Appreciate everybody tuning in. Before we get started today, I do want to make a couple of announcements. We are going to be changing our schedule on YouTube. I've been in discussions with Stock Charts, and I'm going to be doing a new show over at Stock Charts on Thursdays. I'll probably be recording it in the morning, probably actually close to noon. And then Stock Charts will be posting it on their channel, their YouTube channel. That is going to begin next Thursday. And that would be June 27th, I believe, is next Thursday. So we will no longer be doing a Thursday show here at Earnings Beats in the morning. I'm just not going to do two shows back to back. And I'm also finding that doing a show on Wednesday, excuse me, along with the trading room, I just don't feel like I'm getting enough time to put together the trading room the way I'd like to do it. Because literally we have about 20 minutes between the end of this Trading Places Live show and the start of the trading room. So we're going to pass on the Wednesday show. We're going to keep the Tuesday show as is. So we're going to have a Tuesday Trading Places Live show. Then I'll be doing a show over at Stock Charts, which will be recorded and probably posted sometime around 1 o'clock in the afternoon, Eastern, something like that. So those will be the two shows during the week. I will also be doing shorter YouTube posts, just impromptu when the subject hits me. It's going to be very important that you be subscribed to our channel so that you know when these videos are posted. I think they're going to be pretty timely, so you're going to want to check those out pretty quickly when we do post them, and they're not going to be set at any particular time. Again, it's just whenever it fancies me. If I see something I think needs to be addressed, whether it's something I see on the charts, maybe something I see on a YouTube video, whatever, that's going to be kind of a new style that we have here on YouTube. We certainly appreciate all the support that we have gotten on YouTube to date. We are just trying to maybe fit in a little bit better with the types of recordings and shows and so forth that we've seen on YouTube. So that's all part of going into what we're doing. So again, going forward, starting next week, this week, we're fine. Tuesday, Wednesday, Thursday show, Wednesday live, or actually, I shouldn't say that. Actually, Wednesday, tomorrow is a market holiday. It's Juneteenth day. And as a result, all markets closed, bond market, stock market, and so forth. So we won't be doing anything tomorrow just because the market's closed. But Tuesday and Thursday this week, we'll have our shows as normal. And then next week is when the new schedule will begin. But again, please make sure you subscribe to the channel so that you can follow along when we do these other impromptu videos. They'll probably be much shorter in length. I'm thinking maybe somewhere in the 8, 10, maybe up to 15 minute in terms of length. But anyway, I wanted to make sure I pass that along. I'll start pointing it out more often as we get closer throughout our daily market reports, all of our communications with members to make sure everyone is aware of the new schedule. But I definitely wanted to point that out. We'll also be moving to our Earnings Beats digest of just Monday, Wednesday, as opposed to Friday. Personally, that's for whatever reason, that EB digest is one that I have difficulty getting to and getting out just because of getting ready for the weekend, getting all the chart lists done and so forth. Friday's a really busy day for me. So I'll probably, not probably, we're going to go ahead and change that and just do Monday, Wednesday. So still 2 times a week, getting some quality information out to our Earnings Beats community. It just won't be that third day of the week. I think that probably covers it. Still going to be doing the weekly market recap on the weekends. Fab 5, I didn't do this past weekend. That type of video may just be part of these impromptu videos that I'm talking about. So anyhow, just wanted to make sure everyone is up to date on that and understands where we're going with that as we move forward. All right, getting back to the market. This morning, we saw retail sales come in, and I'm looking at them right now. They just came out about half an hour ago. The expectation for retail sales month over month for the month of May was 0.3%, a rise of 0.3%. Came in at a rise of 0.1%, so a little bit less than expected. Again, just kind of showing maybe just a little sign as far as a crack in the foundation of this economic, where we are in the economic cycle. So retail sales came in below expectations. If we strip out the vehicles, so retail sales less autos, expected also to come in at a rise of 0.3%. And instead, it dropped 0.1%. So clearly a little bit weaker than expected. The retail sales report. We do have some other economic reports due out later today. Industrial production, I think that's going to be something that'll be closely watched. That will be out at 9:15 Eastern, so in about 10 minutes. The expectation there for May industrial production is also for a rise of 0.3%. Pretty wide range. The consensus range is from 0.1% rise to 0.6% rise. So I would be watching for, last month was flat. So if we come in with another flat reading or even maybe a negative reading, that would be yet another signal that the economy is slowing down. So kind of watching the industrial production number that'll be out in about 10 minutes, 9:15 Eastern. And then the capacity utilization rate last month came in 78.4%, expected to go up to 78.6. We'll keep an eye on that. The consensus range there is from 78.4, which was the same as the prior month, up to 78.8. So still got some economic news to come just a little bit later today. As we look throughout the rest of the week, we've got housing market index tomorrow, despite the closed market. That is still scheduled for 10 a.m., at least according to my source. Thursday, we've got housing starts and permits. We've got initial jobless claims. The Philadelphia Fed Manufacturing Index, got a Fed, someone with the Fed, Neil Kashkari, speaks. And then on Friday is quad witching day. So that's when we got a lot of different types of options and contracts that expire. Usually you can see some volatility with the quad witching day. Also expect very, very heavy volume on Friday. We normally the 4 heaviest volume days of the year are these 4 quad witching days, which occur in March. It's the March monthly options expiration day, June, September, and December. Those are the 4 days we typically have the highest volume of the year. Just a lot of juggling and repositioning and so forth, which triggers a lot of volume in the market. So don't read into a whole lot of it if the market were to go up and down and say, wow, it was on a heavy volume day. These are always heavy volume days. All right, let's go ahead and take a look at what happened yesterday. And I'm going to start actually by just summarizing from the stock charts, your dashboard. So right here in the middle of the screen, if you haven't noticed it, you should have noticed it by now. But if you haven't, here are some of the key indices that we like to follow along with the volatility index. And yesterday, you can see a lot of green on the board with the market continuing to push to the upside. I would just offer up a bit of caution this week and into the early part of next week. This is option expiration week. As I just mentioned, it's quad witching day on Friday. This is going to be a test for this bull market advance. I'm not talking about a long-term test. I believe the stock market's going higher. We may hit a rough patch over the summer. But I'm convinced the end of this year and into 2025, we're going to be setting all-time highs. I think next year we could easily be 6,000s. Right now we're getting close to 5,500. Seems like these 100-point increments are going by pretty quickly on the S&P 500. we've actually made this move into early summer, or heading for early summer. We've actually made more of a move to the upside than I anticipated. I thought at the beginning of the year we might get up to about 5,300. We've actually gotten up close to 5,500. I still think late summer could present problems for the market as we get closer to the election. Possibly maybe a disappointing reading or two on the CPI, because we have comparables from last year that are going to be difficult to beat to the downside, to come in less than. So I think there's some possibilities down the road for the market to pull back, but I expect it to be very short-term in nature, especially if it's this week. If it's this week, I would expect it maybe to last over a week or so, maybe a slightly over a week. And it's not a guarantee. It's just that there's a lot of money, potential money on the table for market makers to take by taking the market back down short term. It's what we refer to as max pain. Many stocks, because they've been going straight up and continue to go straight up, there's a lot of folks out there in the options world that have been trading calls and puts. The problem is, as you go up, all those puts are out of the money. All of these calls, because we keep going up and up and up and up, the amount of in the money call premium is massive, perhaps the most I've ever seen in the market. So what that tells me is that there's still incentive on the table for market makers to perhaps reverse the action and begin to see some selling in the overall market. We know how overbought areas like semiconductors are. I love the group. I just don't like the risk in the short term. We may keep going higher. And I say this every single month when we do these max pain events. Just because we have max pain that's well below current price doesn't mean that we have to go down or that it's some sort of guarantee. As we go higher and folks keep buying calls, market makers have the options to sell those calls and buy the underlying stock. That's a covered call strategy where you won't lose money if you keep going higher. Even though you've sold the calls and you're losing on the calls, you're making the money on the underlying stock. So it's a way to hedge, which I'm assuming all market makers do. At least if I was a market maker, I'd be doing it to protect my business. Because if prices keep going up and I'm just sitting on the short side on these options, selling the calls, I'd be out of business if the market didn't come back down. I mean, there'd be a lot of money I'd be owing. So the prudent way to trade this is to sell those calls as a market maker and turn around and buy the stock. When volume starts to slow, that's the market maker's opportunity to perhaps take prices lower. And I say perhaps because, again, this is not a guarantee. I hesitate to make changes to my portfolio, even though there's this risk out there, because we are in a secular bull market, and secular bull markets can take no prisoners at times. And as a result, sometimes it's just best to remain on the long side. If I was thinking about money that I'm investing for next year or 5 years or 10 years from now, I wouldn't even pay attention to what I'm talking about with max pain. Stay long, stay the course. Right now, I'm seeing no signals, my signals, that suggest that we've got any kind of an imminent big drop coming that's going to last for a long period of time. So the way I approach this market is, if I've got long-term money, I don't worry about it, just let it go. If I've got short-term money, then I'm thinking more. One of the things I talk about during Max Pain Week is that it's opposite George Week, a Seinfeld reference. Just that basically whatever's been working up until Max Pain Week many times will struggle. And the things that have not been working all of a sudden come back to life. So one thing that I'll be doing throughout this week, probably, I started a little bit yesterday, is moving some of my aggressive money, like in the QQQ, and moving it into some of these sectors that might benefit from opposite George Week. So energy, materials, financials, industrials, maybe even healthcare. Healthcare hasn't had a huge move. It did make a recent breakout, but it hasn't had a huge move. I think we're probably okay there. Anyhow, looking at the action from yesterday, we still went higher, even though these things are in place. Sometimes we see selling start on Tuesday. Sometimes we see it start on Thursday. Sometimes we see it start next week. And you might say, well, why would it start next week? Options expire this Friday. What does next week have to do with it? Well, not everyone closes out their option position. Many will exercise those options and take on the stocks on the long side. And that forces market makers to then do what? Take the short side. So market makers are still on the hook on the short side going into the week after options expiration. The worst day of the calendar month, historically, I'm not saying every month, historically, by far, the worst day of the calendar month has been the Monday after options expiration, which would be Monday, June 24th, this coming Monday. So just keep that in mind. It's just something that I think about that makes me wonder if, we're going to see a sell-off at some point or at least a pullback. It's not like we see market crashes, although we've seen some pretty big drops. I would just be thinking about this in terms of the most likely directional move in the market. And what it tells me is that we're probably going to see rotation because the biggest group, quite honestly, that's subject to max pain is technology. Technology is where everything has been flying, especially in the semiconductor space. So, and I'll show you in just a little bit how you can find some of the semiconductors that might be subject to some of this selling. But anyway, yesterday we had the Dow finish up 189 points. That was a 0.5% rise. S&P 500 up 42. That was 0.75% rise. NASDAQ, another 168 points. We're just going straight up, literally like in a melting pot here. The NASDAQ gaining almost another full percentage point. If you drop down here to the small caps were weak early. They actually came back nicely at the end of the day, threatening to overtake the NASDAQ. And I mentioned to our members in our weekly market report yesterday that I think this is go time for small caps. This is the time, and I'm not trying to repeat myself because I've been wrong on small caps for a while. What I'm saying is that on a relative basis, looking at the intraday behavior over the last several months, we are at a major support level on the IWM relative to the QQQ. So if we continue to lag, we are breaking down. We've already broken down. If we look at from close to close, we've already broken down. If we include gaps, if we exclude gaps and only look at the action from the 9:30 opening bell to 4 o'clock, that's where we're still holding on to support IWM versus the versus the QQQ. And yesterday actually was a pretty good day in terms of intraday action because small caps opened way weaker than the rest of the market, and yet it came back and was almost the best performing index by the end of the day. So we did have a good intraday performance by the IWM yesterday. I want to see more of that. And to be honest, IWM, there's going to be very few stocks in the IWM that's subject to max pain. Smaller cap stocks, number one, don't get traded in the options world nearly as much as many of these large cap names. And again, if money just rotates away from technology, large cap tech, we could certainly see rotation into small cap. I don't expect the whole market just to sell off. I think technology sells off potentially, and other areas of the market kind of get some of that money rotating out. And so on a net basis, I think the S&P maybe could drop a couple percent. I'm not really looking for anything huge. I can tell you that both the Spider and the QQQ are trading right now more than 10% above max pain. So all I'm looking for is maybe a little bit of a directional move toward max pain levels. Anyway, I'll talk about this a lot more this evening later this afternoon at our 4:30. Actually, I think maybe it's 5 o'clock max pain event. But you can sign up as a free trial to Earnings Beats, to our paid service. You have to provide a credit card, but it is free for 30 days. And if you do that, you can join me this evening. It's really an interesting topic that our members love. We do this every month. And I think it will help you manage risk. It's a very, very important part of managing risk, in my opinion. Anyway, we'll talk a lot more about that later. One other thing to mention here is that the VIX, oh, by the way, the NASDAQ 100, that's where we see a lot of these volatile, large cap tech names, especially those semiconductors, software stocks, and so forth. That index rose 1.25% yesterday. So the NASDAQ 100 still performing extremely well right now. Volatility index up slightly, still down below that 13 level. A lot of people think, oh, low VIX means it's going to go higher, and that means the market will go down. Not really. Yesterday, the VIX actually went up 9/100ths to 1275, and yet look at the action, pretty bullish action across the board. So it's only when you get above about that 20 level in the VIX that I get really concerned about the stock market. Even above 17 starts to make me nervous, 17 to 20 range. But when we get above 20, there's no more concern about it. I sit out. There's no way I'm taking a shot when that volatility index gets above 20, especially as it gets well into the 20s, really starts to paint a picture of bearishness. We're way, way, way far away from that right now. All right. One thing I did want to show you here is the sectors. So if you scroll down over here under member tools, you'll get to this sector summary and click on that. And you'll see yesterday, consumer discretionary and technology. Consumer discretionary, been talking about how June, really likes the month of June. Consumer discretionary so far doing pretty well in the month of June. Technology's been off the charts though. I mean, if we go back, we change this period to 1 month. You can see technology up 9%, communication services 2.3, consumer discretionary 1.4. So we're still seeing money rotate into those aggressive areas, which is awesome over the last month. This move to the upside is being supported by aggressive areas, which is awesome. Everything else is not paying, not following along. And that's why you're starting to hear a lot of folks talk about breadth. The breadth isn't good. Did you see what happened in 2023 when everyone was complaining about breadth? Stock market went up considerably throughout the entire year. Breadth, I think, is something that is way overhyped. First of all, the stock market, the S&P 500, the Dow Jones, the NASDAQ, these are market cap weighted indices. Why are we worried about small if you're invested in the SPDR, do you really care about the $162 million industrial company? Or do you care about Amazon, which employs how many hundreds of thousands of people around the world? When you look at an equal weighted index, you take those two companies and you say they're worth the same. How crazy is that? Of course they're not worth the same. I want to know what Amazon's doing versus this little company I never heard of that maybe employs 75 people. Hey, not that that's a bad thing. I favor small business or smaller business. But anyway, it's just something that we should be aware of, that our major indices are market cap weighted. And this is not a bad thing when we see these areas of the market that house these heavy hitters in terms of technology and these large cap growth names. So I like the fact that technology, communication services, consumer discretionary, that these areas continue to perform as well as they do. I think that's awesome for the market. But what we could see, would it hurt anything if technology, which has been so strong, were to give back 5%? I mean, I'm not saying it's going to happen. I'm just saying it could happen and that the odds are increasing. But if we gave up 5% there and we gained it in some of these areas that have been underperforming, look at energy. Energy's been getting killed, down 7%, which is why I say all along, don't just hold on to energy and materials. Don't just hold on to gold, silver, all of these different commodities and so forth, because they go up and down. They're extremely volatile and they do their best work when we are in a long-term period of a rising dollar. Also, many of these areas do better when we have extremely high volatility readings. I just pointed out we're still at 12, which is an extremely low reading. This is not the right environment to be jumping into gold and holding gold, thinking it's going to be, the 2000s all over again. There will be a time for gold. I think it's going to be many years from now, but there will be a time for it. Wait for it. In the meantime, invest in the S&P 500 and the key areas in the S&P 500, like these growth names. All right, so that's 1 month. How about year to date? Technology, 20%. Communication services, 16.65%. And the reason why I'm not thinking that consumer discretionary necessarily is going to get hit is because if we look year to date, consumer discretionary is up less than 2%. It's 10th out of 11 sectors. It's just starting to move back to the upside, in my opinion. So anyway, I thought this was all worth pointing out. 10-year Treasury yield. Let's move on to take a look there. Get an update. So we're at 425. We're down a little bit, down maybe about 2 basis points this morning. Trending down now below the 20-day EMA. I think that's an important change in character that we've seen on this chart over the prior several months in 2024. You can see that we were mostly trending above the moving averages. Now we're breaking down and starting to trend beneath the moving averages. So until that changes, you've got to recognize this, in my opinion, as a declining trend back toward the downside, maybe moving back down toward 4, maybe even again that 380 level. You know, we get another CPI reading or two, the June CPI that'll be out in July, or maybe even the July that's out in August. If we get really low readings like the last one we saw, I think you're going to see the last folks worried about inflation. They're going to be clinging by their fingertips to the whole inflation story because it's going to basically be dead if we get a couple more readings to the downside or less than expected. S&P 500, there's your move, another move to the upside, and zero in here. Another hollow candle. I mean, that's what, five hollow candles out of the last 7. And if you're looking for a big red-filled candle, you'll see one here back latter part of May. And then here's one that's not quite as bad, but down, it did close below the 20-day. And that was the latter part of May. But look at what's happened throughout this entire month here in June. We've either had, I mean, the market's been up almost every day since the end of May. Really hard to be bearish. I don't understand how anyone's bearish. All-time highs, unless you've got a lot of bearish secondary signals all coming together, and I mean a lot of them, it's hard to go against price volume. You're breaking out to new all-time highs. Even Max Pain, what I'm talking about a short-term issue. I'm not talking about a long-term issue. So anyway, I think the S&P still looks poised here. If we don't go down with Max Pain, we may go straight up, continue going straight up into earnings season. I mean, I think this end of July or end of June, second half of June is probably an opportunity here for the bears to maybe at least get some short-term relief and some pullback of some sort in the market. If that doesn't happen, I don't know. Look at the hollow candles here. I mean, these hollow candles, even when we've had intraday selling, we see end of day buying. So if you're trying to go against this market, at least wait for a reversal. We just keep closing at or near highs every single day. Futures right now are pretty flat, or at least they were as of 25 minutes ago. But yeah, I mean, this action, very, very solid here. IWM going sideways, but I do like that recovery yesterday off the downtrend. Remember, we gapped up last Wednesday with the May CPI report coming out. Then we've seen nothing but selling, although we have come off of those lows so that the AD line is not as bad as the price action itself. And then yesterday we have a reversing bullish engulfing candle. I suspect in the near term, IWM goes higher off of this. I mean, another reversing candle right at about this gap support level. I would think it would go higher, but I've seen so much disappointment in this group. I'll wait to see it. Transports, big hammer that we saw print back on Friday of last week. Yesterday came back, had a really nice session, finished near the high of the day. So this is another index that I would expect that's been beaten up. But if money rotates, I could see transports having a big week. All right, moving on to the chart of the day. Just want to let everyone know again, we have this monthly options Max Pain event coming up this evening or this afternoon. It does start at 5 p.m. You do need to be a paid member at Earnings Beats. So click on that no-cost trial. Come in and join us. You won't be disappointed by this event tonight. I can promise you that. All right, chart of the day. The one chart I want to give you here that I think is pretty critical. We've been talking about technology and its leadership and what it's been doing the last month, showing that it's been up, 9% or whatever. What I've done here on this chart, and I think I put it in maybe the weekly market recap over the weekend in that video, or I talked about it. I'm not sure where I posted it. But here is a 65 hour. This is an hourly chart that goes back 10 years. And so I ran a rate of change for the last 65 periods, which is 65 hours. Now, what's the significance of 65 hours? Well, every trading day is 6.5 hours. So 65 hours is 10 trading days. So what I'm looking at is just looking at history going back the last 10 years throughout this secular bull market advance and looking to see where this rally ranks relative to all the 10-day periods over the last 10 years. And we're at about 10% right now. And if you look back, I mean, to go back 2 weeks and have a 10% move higher in 2 weeks, it's not unprecedented, but it doesn't really happen that often. I mean, back from 2015 to before the pandemic, it literally only happened twice in 6 years. Since the pandemic, let's ignore those because that's coming out of some really crazy lows. And of course, you're going to get some crazy moves back to the upside. But since then, we've gone back up to about 10. But really, we've only had moves above 10 during that cyclical bear market. So we get those relief rallies. You'd be going down, market be getting killed. And then all of a sudden, we'd have 1 or 2 weeks where we'd fly back to the upside, just a counter trend rally. And that's what's triggering a lot of these 10% moves. But here, we're clearly in an uptrend, breaking out all-time highs. This move is kind of unprecedented to see technology going up this fast, this far, this fast. So it doesn't always mean we're going to go down, but it usually means we peak. So I would have at least expect the pace of this move to the upside to slow. That's what history tells me. Anytime you get up here, it's not like you see us continuing to go up to 20% or 30%. I mean, again, we're talking about 2 week period. 10% that's a good annual return. You get that in 2 weeks, you got quite a move to the upside. So to me, it just provides, again, a little bit more risk because we've already gone up so much. We're going to be extremely overbought, and we now have Max Pain to consider. So anyway, think about joining us this evening. We're going to talk about this a lot more, talk about individual stocks that are most at risk here over the next week to 10 days. I think this is probably one of those can't miss type of webinars. So make sure you go over to earningsbeats.com, hit that start your no cost trial button, get set up, and join me today at 5 o'clock. You certainly will not regret it. All right, that's all I got for today. Let's get a quick update on where the market is right now. So go back to the dashboard. We got the Dow up 19, S&P up 5, NASDAQ up 8, NASDAQ 100 up 15. All of those less than 0.1%. Small caps flat. So it looks like maybe small caps coming back a little bit. The rest just kind of sitting right where the open was. Take a look, though, at some of these semiconductors. Again, making huge moves. Micron, Qualcomm up another $6. Teradyne. And then look at CMG, which, again, another one of our Qualcomm's a portfolio stock. CMG is one of our portfolio stocks. These stocks going up, doing extremely well right now. It's hard to bet against them, but in the short term, just keep in mind, we do have option expiration this Friday. Anyway, that's it for me, everybody. Again, like our video, subscribe to our channel, and we will be changing our schedule again going into next week for those of you that came in late. Starting next Tuesday. This week, except for the holiday tomorrow, we won't be doing anything tomorrow. So there'll be no show. There'll be no live trading room. There's nothing to trade. So we'll wait until next Wednesday to pick that back up again. But so Tuesday and Thursday this week, it's the same. Schedule is the same. Next week, next Tuesday, we still continue to do our show as is. It might be a little shorter in length. Still trying to debate that a little bit. But next Wednesday, there will be no more Trading Places Live. I want to prepare more fully for our trading, the trading room, live trading room that we do at 10 a.m. every day. We may even start that trading room at 9:30. We're going to talk more about that here. So it might be right when the market opens. and try and get at least that first hour in, and maybe even start a couple minutes before 9:30, just because of some of the things that are happening either with earnings. Won't be as much now because there aren't many earnings coming out, but just news stories before the market opens, that sort of thing, to give our members just a little bit more advance notice before we go into live trading for that session. Anyway, next Thursday, June 27th, will be a change. So I'll no longer be doing the Thursday 9 a.m. show here at Earnings Beats. Instead, I've agreed to do a show over at Stock Charts. It's going to be an every Thursday show. I'll be recording it late in the morning. It'll probably be posted on YouTube sometime around 1 p.m. or so. I would certainly encourage you to check that out. It'll probably be a little bit more bigger picture show because it's only a once a week show, but I do expect to talk about individual stocks in there as well. Maybe some stocks that have been building up over the prior week, or maybe some stocks breaking down, maybe some patterns setting up, that sort of thing. So I think it'll be a very solid show, fast paced. And I think you're going to want to check that out. But anyway, those will be some changes going forward. I did mention also that I'll try to do more impromptu, maybe 10-minute type videos on news stories of the day. Could do something on Max Payne. I mean, it could be on anything, sentiment going into a month, just anything that I think of. But those impromptu videos will be recorded at any time of the day. So make sure you are subscribed and make sure that your notifications are on YouTube, so that whenever we do these, you'll be notified so that you can check those out. They're going to be very time sensitive. Anyhow, have a great day, everybody. I'll be back on Thursday for your next Trading Places Live. Happy trading.